Welcome to our podcast on Accounting Standards Update number 2015-05, Customers Accounting for Fees Paid in a Cloud Computing Arrangement. In this podcast, we'll discuss the reasons for issuing the guidance and an overview of what the guidance means, the criteria provided in the guidance to determine whether a cloud computing arrangement includes a license of software, the accounting treatment for arrangements that do include a license of software, and the transition, effective date, and disclosure requirements. My name is John Hunt, and I'm a Senior Manager in KPMG's Department of Professional Practice. And joining me in this podcast today is Paul Fayed, who's also a Senior Manager in KPMG's Department of Professional Practice. Let's first start with a background discussion on why the guidance was issued. Prior to the issuance of ASU 2015-05, there was not explicit guidance specific to customers in cloud computing arrangements. These cloud computing arrangements include software as a service, platform as a service, infrastructure as a service, and other similar types of hosting arrangements. In the absence of guidance specific to customers, some companies were analogizing to guidance provided to cloud computing providers, and some were analogizing to leasing guidance, which led to diversity in practice with regard to how similar transactions were being accounted for. ASU 2015-05 provides guidance to determine whether a cloud computing arrangement provides a customer with a license to the underlying software. If the arrangement provides the customer with a license of software, the customer should then apply the guidance related to internal use software, which requires consideration of whether certain costs should be capitalized or expensed as incurred. If the arrangement does not provide the customer with a license to the software, then the customer would account for the arrangement as a service contract and expense the cost as the services are received. A hosting arrangement is defined as an arrangement in which the end user of the software does not take possession of the software. Instead, the software application resides in the vendor's or a third party's hardware, and the customer accesses the software application as needed. Based on ASU 2015-05, a hosting arrangement includes a license of software if it meets the following two criteria. First, the customer has the contractual right to take possession of the software at any time during the hosting period without significant penalty. And second, it's feasible for the customer to either run the software on its own hardware or contract with another party unrelated to the vendor to host the software. Again, both of these criteria need to be met in order to conclude the arrangement includes a license of software. With regard to the first criterion, the term without significant penalty means that the customer can take delivery of the software without incurring significant cost and has the ability to use the software separately without a significant reduction in utility or value. Now that we understand the background and the requirements for determining whether an arrangement includes a license of software, Paul, can you talk us through the accounting treatment for arrangements that include a license of software and a service component?
Sure, John. For arrangements in which the two criteria that you just mentioned are met, entities will need to allocate the fees between the software license and the service elements. The ASU does not prescribe guidance on how to allocate between multiple elements, but in other allocation guidance, allocation made on a relative fair value basis is generally appropriate. As John mentioned earlier, fees related to the license of software are subject to the internal use software guidance and would typically be capitalized and amortized over the expected useful life of the software. Fees allocated to the services elements would be expensed as incurred.
So Paul, a couple questions. First, does the ASU provide any guidance related to upfront costs, such as implementation or setup costs incurred, whether they're paid to the SaaS provider or another entity? And second, it seems like this could be a pretty significant change for cloud computing customers. Could you talk through at a high level some of the main financial statement impacts?
Of course. Upfront costs were intentionally excluded from the scope of this ASU, so it does not provide any guidance related to how to account for them. Regarding financial statement implications for customers in cloud computing arrangements, I think you're right that these could be very significant. Capitalizing costs versus expensing them is the obvious change, but think about the impact on financial statement metrics such as EBITDA, where a company prior to the ASU may have been capitalizing costs for which the related amortization would be excluded from EBITDA. Under the ASU, the costs may be expensed as incurred and therefore included in EBITDA. From a cash flow statement perspective, amounts paid that do not relate to the license of software based on the guidance of the ASU will be classified as an operating activity, whereas in the past, they may have been classified as an investing activity if the entity was capitalizing the costs. So John, now that we understand the standard, can you walk us through the transition options, the effective date of application, and the main disclosure considerations?
Sure, Paul. From a transition standpoint, entities can elect to adopt ASU 2015-05 either prospectively for arrangements entered into or materially modified after the effective date, or retrospectively. For public business entities, the standard is effective for annual and interim reporting periods in fiscal years beginning after December 15, 2015. For all other entities, the standard is effective for annual periods beginning after December 15, 2015, and interim periods in fiscal years beginning after December 15, 2016. Early adoption is permitted for all entities. Entities that elect prospective transition should disclose the nature of and the reason for the change in the accounting policy, the transition method, and a qualitative description of the financial statement line items affected by the change. Entities that elect the retrospective method should disclose the same items in addition to quantitative information about the effects of the accounting change, including the cumulative effect the change had on retained earnings or other components of equity or net assets in the statement of financial position as of the beginning of the earliest period presented. So with that, we'd like to thank you for joining us in this podcast today. We hope that the information provided gives you some insight into ASU 2015-05. We'd also like to remind you that you can find additional information on this accounting topic and many others through our Defining Issues publications on the Financial Reporting Network website, which also includes many additional podcasts and thought leadership publications on a host of other accounting topics.